Well, with that, why don't we get things started? And I thought it would be great if we started things off by having some brief introductions from our esteemed panelists here today. Sally, if you want to kick that off with a quick introduction.
Sure. Thanks. It's great to be here, Eric, with you and Jeff. So I'm Sally Duby. I am a partner and the chief sales officer at the Bridge Group. I've been in tech sales for a really long time. And I am going to be dating myself now because I started in tech sales really at Oracle. In 1986, I started as an inside sales rep, was one of 10 at Oracle, and got the privilege of working alongside Mark Benioff. That's how he got his start as well. When he joined Oracle, he was an inside sales rep. And then I went and I moved into various other roles, management director roles for both our inside sales team as well as our SDR, BDR team there and our channel team. And then went on to build or optimize, if you will, inside sales teams, SDR teams, and some field sales teams at other tech companies throughout the years. But I've spent probably the last 20 years or so in consulting, and where we're helping, hundreds of other B2B companies at the Bridge Group. And one of the things the Bridge Group is most known for is our benchmark and reports on the SDR and the SaaS AE roles that we publish one every other year. So we've got some data we'll be talking about and sharing from that too later on.
Yeah, and if anyone hasn't seen those reports, I'm a big fan. I was a fan even before I met Sally. Some great data in there, to help as you think about things like annual planning. With that, Jeff, do you want to give a brief introduction?
Sure. Thank you, Eric. Sally, good to be here with you as well. I started my career in tech about 20 years ago, a little over 20 years ago as well. And even though I officially had other roles, product manager, some product marketing, help build a solution engineering team, even before the word sales operations was out there, I was the one in the back end doing the things that I thought needed to be done. Why don't we have a pipeline somewhere? We bought Salesforce way back when it first came out, and I took the initiative to kind of learn how to configure it and create some reports and track our pipeline, and I documented our processes and got involved in planning. I've been through pretty close to 20 planning cycles. I am not saying all of them were efficient or all of them were good. Probably a lot of them were not, but that's what gives you these lessons that hopefully I'll be able to share with you today. Since then, I've led or started or grown revenue operations teams at 8 different companies. And currently, I'm very happy to be part of Revcast as the Chief Sales Ops Officer. I think the role is an important one, and we should have that elevation within a company and within the industry as well. So very happy to be here, and thanks for having me.
Awesome. Thanks, Jeff. Thanks, Sally. Well, let's kick this off, and I'd be remiss if I didn't open this up by saying the obvious, which is that the economy and business environment is very different today as we go into planning this year versus how it was, a year and definitely a couple of years ago. We've gone through some ups and downs. Sally, I'll ask you this. What is the state of the economy today for SaaS sales as we head into this next year?
Yeah, so, I think we're all feeling this and living and breathing it as we speak, but it's still tough for many companies. We see, many companies of much longer sales cycles, right? Lower average deal sizes to get started, and so many more people are involved in the buying process and the buying cycle today. So many more deals are being lost to, no decision. The company ends up not doing anything, right? Because they're going to try to weather it out with however they're currently doing the solution. Some things that I think were concerning as we got rid of a lot of people. We did overhire in, sort of as we came out of the pandemic. We overhired. And now we did right size, but some companies may have right sized a little bit too much, if you will. And I think that's really going to hurt them as we start to come out of this. You won't be able to fund all of the roles that you need. One of the good things that I do like that has come out of this is that, it's not growth at all cost. It's actually smart revenue, smart growth, leading to more focus on profitability, which I think, I don't know. When I took business in college, profitability was was what it was all about. So this has always been the tech world's always been a real conundrum for me, in trying to understand that mentality. Um, but I think one of the roles that does concern me is a lot of SDR teams were totally laid off or were way cut down. And how do you build pipeline without the SDRs? We know AEs do some prospecting, but they typically can't do enough prospecting to keep their pipeline full. And we even need more pipeline today than before because of longer deal sizes. Or longer deal cycles. But some good news, I did see that Mark Benioff announced last week, I think it was, that Salesforce was going to be hiring back about 3,000 people of the 10,000 or so that they laid off. And they were going to be focusing on giving jobs back to those that they had laid off. So hopefully that is the start of, getting back on a better track.
Absolutely,
tech
absolutely.
world.
You see that as a trend, not just with Salesforce, but with others?
I have seen a little bit more hiring when I talk to companies and when I'm doing my own prospecting. I always look what's going on in the company, what roles are being hired and how much hiring is being done. And I am seeing a little bit more hiring, in particular in the sales world, which to me is always a good sign to
Yeah,
see.
that
So hopefully
definitely a
it
good
sticks.
sign. I'm hoping we're over the time of app or people layoffs, right? And that we're
Yes.
to growth, even if it's more efficient growth. Um, it's funny you mentioned Benioff earlier, and I remember him too as being someone that was always worried about laying off too many and not being ready for the uptick, and
Yes.
he thought his biggest regret from the last downturn was being too aggressive with layoffs. So it's good to see them hiring back some of the people that they had to lay off in this last round of overhiring. Moving on to the next topic, I wanted to start off the planning conversation with some conversation about best practice on planning. Sally, do you want to start?
Yeah, thank you. So, I think one of the things that always used to drive me crazy when I was going through planning was, there was no thought to is how real is this and how are you going to execute the plan? And so Jeff, with the role that you're in, love the new title, by the way. I think that, having you guys heavily involved in the planning process and companies leaning heavily on sales ops and rev ops to provide the data and the picture of what's going on. So we really understand our business and understand, how are we going to actually make any new goals work compared to where we've been, and what are the trends going forward. I think that's just so important to have all that data at your fingertips and have a really good understanding, things like, the data by rep, by team, by market segments, by quarter, all the way from lead to closed won, as well as the lost business. What was lost, and dissect that. What was lost in what market segments and what industries, what products, by what rep, why was it lost business? When you look at all that information again from lead to close, and you look at your conversions and the verticals and what the products people bought and why they didn't buy, I think that can really help you in formulating a plan that can be executed. And then it helps you drive and understand, we know we're all going to grow, even though things have been tough, but what do you need to change to hit that growth? You can't just throw spaghetti on the wall and have a, that it's going to stick. Just because I said I want, 50% growth next year, doesn't mean it's going to happen. So what do you need to make that happen in the way of resources or new tools? How am I going to optimize my current people? Because I don't think we're going to do the growth at all costs again for maybe a year. So it's not just going to be hiring people and lots of bodies. There'll be a few additionals, but where are you going to be able to find that additional growth?
Yeah, it's interesting. You mentioned maybe a year.
We always go back to it.
I was going to say the business does seem to work in cycles. I've been around, in tech since the .com era, and I've seen a few cycles of, over hiring and then needing to, whatever the term is that they want to use at the time, lay people off, fire people, right size people. I think as humans, we tend to over rotate one way or the other. But on the good news side, Diana was just posting in chat that she also sees business picking up. She sells to recruiters, and their business is picking up, and that's a great early indicator, because if the recruiting is definitely a bellwether, because you need those people in place before you can get the rest of your hiring in place. And I know those were definitely that group of people is definitely over affected by the layoffs we've seen in tech in particular. Jeff, I know there's a lot of companies I've worked with that start planning early, saying Q3, early Q3 in some cases, and others that don't start until the fiscal year is almost over. What's your take on that? And what are the drivers for when you should start planning cycles?
Yeah, Sally said a couple things. You have to know your goals, you have to know your business, and you have to know how you're going to get there. So you have to start early, because planning does not start with numbers or a spreadsheet. Maybe it starts with a general, we'd like to grow 30 to 40% next year, but you don't start with, let's grow 40% and how many reps do we need to hire? You have to start with understanding your business, as Sally mentioned, and then you have to start thinking about what's working and what's not working, and the strategies you're going to use next year to get to your goals. Do you want to significantly invest in EMEA to grow that small office into a bigger one? Are you going to add some additional sales channels? Are you really going to put a focus on win rates by investing in sales enablement, for example? So you've got to talk about those strategies that are going to get there, and then you got to think about the specific levers of getting there. The investment in sales ops to create new onboarding is an investment, one of those levers that can help you get to your goals. Maybe you're releasing a new product, which is going to help you with your positioning and competitive win rates, for example. All of this is done without jumping into a spreadsheet. There's a lot of debate and discussion and alternative opinions and views on this. A lot of that does require some data-driven analysis. So you're going to pull in data to try to see what those potential outcomes are, what it may cost to get to the outcomes, and what the impact may be. And you're going to have hopefully some real decisions involving a lot of people, real discussions involving a lot of people, to come together and ultimately align on which ones you are going to target for next year. At that point, and once you get to that point, which could take a full quarter or a couple months or several offsites, going down into say middle management or managers to get their input and feedback, and then all the way up to the board, and then back down and back up again. Then you jump into the spreadsheet and you start cranking out what that looks like in terms of staffing and segmentation and quota setting and all the things that you need to do. You don't start early enough, one of two things is going to happen. You're going to get squeezed and you're going to take shortcuts on the first part. So as Sally said, you're going to have things in there that we're going to grow our selling price, or we're going to increase our competitive win rates by 10%, which you haven't identified, nor have you agreed on funding the levers that are going to help you get there. So you're not going to get there. Or you're just going to skip steps. You're not going to analyze the assumptions and the data that go into a plan, the ramps, the recruiting cycles, the hiring profiles that you may need to hit. And you're just not going to have a great plan, and you're probably not going to be very successful in getting there. So I think you have to start early enough talking about what you want to achieve next year and how you're going to get there. The actual number crunching can happen in Q4, but I think if you don't start middle to end of Q3, you're probably not going to get through all of those things that you really truly want to get through in terms of planning.
Yeah, let's talk a little bit about the levers. I mean, thinking about levers, you have in your plan to achieve your targets and your goals, obviously you have to ensure that they materialize, right? That they're not just cells in a spreadsheet. Sally, does planning end, and when is the plan improved? Like, when do you think about improving the plan, and how do you ensure that you're not just, creating those numbers in a spreadsheet during planning and ensuring that you're tracking to it?
Yeah, so I think this is one of the areas where companies kind of struggle with, is that they get a plan, they get their numbers, but then tying it to, again, reality and how do you make it happen is where things fall apart. For me, I was always a detailed person. So one of the things that I really liked to do was, I broke it down and I did a bottoms up plan, if you will. I looked at, what are the leads? What was that pipeline that I'm going to need to be able to make my sales numbers, and then break it down by rep. And up to the sales rep line. And then I would be able to break that down into what are the activities that need to drive that, what are the conversion rates, and based it off of, what have we been doing the last 2 quarters? Okay, we've got some opportunities for some improvements. So maybe we can increase that conversion percentage by a point or 2. And I lay it out, and then that's how I always like to present it to my sales teams. Here's, if we look at it, here's what you need to do on a daily, a weekly, a monthly basis, a quarterly basis to hit these new goals. Here's the resources that we as a company are going to apply, whether, again, it's new tools, or we're optimizing things, or we're putting in new training programs to help make it happen, right? We've invested in new messaging, or we've got a new product coming out, whatever that is, but outlining all of that and giving that to the team so they understand how they can make it happen, I think is really important. Because I one of the things that drives me kind of batty about tech companies is we seem to equate growth and scaling with just adding more bodies. And there's that's not what growth and scaling is about, is just adding headcount. As I think what we just experienced over the last year. That didn't work. And so you've got to be able to optimize and look at many other things besides adding people to the equation and bodies to the equation to make things happen. But I like to have a detailed plan to lay out and present so that people know it's not, we just weren't throwing stuff against the wall to see what sticks.
Yeah, I think those are all good points. I mean, I remember people are saying things like the golden age of SaaS, like it's over, or the golden era. But when things were heavy growth, a lot of companies were constrained by headcount. So that's why they started thinking of the planning that way. And now headcount maybe has been less of a constraint. And so people are starting to ignore some of the capacity issues. And I think that's also a bad thing. It's the balance of all these things, right?
Exactly.
Jeff, let's dig in a little bit more with you into this too. What are some of the tactics that you've used to drive improvements to these levers that maybe you identified during your planning cycles?
Yeah, I think Sally is correct. Once you've identified the levers, and let's just say it's increasing the selling price, the average selling price, you need a plan. And it's not just a plan, it's a formalized plan. And what I mean by that is it has an executive sponsor. It has a defined and clear owner. There's a cross-functional project team that is set up, that is given the space and the resources that they need in order to execute this. You've got to think of it as a multi-month, if not multi-quarter sort of program. For the team, you need to think outside of just sales and marketing. If increasing the selling price involves some product functionality, someone from product needs to be part of that team so that they're also accountable to helping deliver that outcome. You need obviously a project plan, you need timelines, dependencies, deliverables. And very importantly, you need a decision-making framework. If you're a fan of Rapid or Daisy or something like that, you need to have that as part of the program. You need a great communications plan so people know what you're doing and why you're doing it and how you're doing it, and so you can drive and manage the change. But I think most importantly, Eric, too often we put this in a plan and maybe we talk about it. How would we do on increasing our average selling price by 20%? And we look at the number, we go, we've got to do better. You've got to talk about it a lot. It should be tracked in forecast calls. It should be tracked in other weekly cadences. It should be tracked in the e-staff. It should be tracked in board communications. You need to stay on top of it and once you define the metrics that you want to track and the ways to get there, it should be tracked as much as you track your revenue forecast. And that, again, drives the accountability at all levels of the organization in order to achieve those outcomes. The failure to get to where you think you can get, to me, almost always come down to losing interest or, excuse me, moving on to some other things because you haven't formalized a program and you haven't formalized a team that's being held accountable in order to achieve those outcomes.
Thanks. We had a question that came to me about attrition, and it's an area I wanted to ask about anyway, so I'm going to incorporate those together. Attrition always seems to be a problem, a killer. When it comes to being behind, in your plan, having more attrition than expected once you're in the new fiscal year. Can you comment to the real cost of attrition, Jeff?
Yeah, I'm going to try to not use a lot of numbers because I'll confuse myself with them as well. But if it takes you 2 months to backfill and you have a 6-month ramp, the amount that you're losing in terms of street quota is at least 50% of a fully ramped rep. But the reality is the cost is much, much higher because most reps do not achieve full and consistent productivity until they've been there for a year or maybe 2 years. So if you're losing one of these reps, replacing that rep could take far longer, and you could be losing the equivalent of a full rep or even more if you have to backfill for attrition when a good productive rep leaves. So those are the costs in terms of reaching your revenue and your growth plan. There's also real costs in terms of expense, the ability to recruit, the having to onboard them, all the other things, the time that it takes for managers to also spend time with new reps and ramp them up, et cetera. So there's definitely costs to both sides. And the thing that kills a plan is not planning for attrition at all because you're going to have it, or not planning for it in a realistic way. If you know that the month after the final commission checks of the year, you usually lose a couple people because they wait for that check and they leave, you have to assume you're going to lose some number of reps in that month. The other thing that kills it is not being allowed, and I use that word specifically, but not being allowed by finance to start recruiting against those backfills earlier. If you actually can map out your attrition, and I would do more than just put a number against it, 25% or 40%. If you can map it out by segment or geo by month of the year, then you can get agreement to say, start backfilling for those assumed attrition spots a month, 2, maybe even 3 before that, so that by the time it happens, you're already ahead of the game of ramping up that rep. And the additional cost of a little bit of overlap is really nothing compared to the opportunity for growth and closing business that you're losing. And if the attrition doesn't materialize, then you just hired earlier and you pin and delay some future headcounts. So not properly planning for attrition, not being realistic about it kills a plan. Not getting agreement to hire ahead of that planned attrition can kill a plan. But also not managing the attrition that you do control, for example, promotions from one segment to another. If, say, the enterprise team is allowed to come in and grab a mid-market rep whenever they want with no notice, mid-market's going to have a challenge of staying to where they need to be in terms of number of reps. And that's attrition to the mid-market team, regardless of where that person is or isn't going. So come up with a plan for how to do that. Know when it's going to happen, and then you can hire ahead of that as well. So I think those are the 3 things you need to do: is plan for it, plan realistically, try to get agreement to hire ahead, keep a close eye on it, manage the attrition that you control. And of course, do the other things to reduce that cost. Invest in onboarding to reduce ramp time. Make sure that you're investing in your managers as well, who are really key to ramping and onboarding new reps as well. Make sure they have enough pipeline to start filling it up and starting to be productive. See what your best reps do and try to replicate them in terms of the actions and the activities and the milestones and the benchmarks. I think all those things together will allow you to get a handle on attrition. And I've seen some companies that have a good handle on it, and they're almost always able to manage it because they understand what's coming and they have this agreement to be prepared for it.
Now, Sally, I know as Bridge Group, you have some benchmarks, right? So can you share, would you be willing to share what some of the benchmarks are you've seen related to attrition, and maybe, comment on that and some of the ways that you see companies improve their attrition rates?
Yeah. So, 2022 was part of the Great Resignation, right? But what we've seen, obviously, since that has changed, and were a ton of layoffs that started happening, is that voluntary turnover dropped from 36% in 2022 to 25% this year. I would venture to say that maybe that's even lower than that, because a lot of people just aren't quitting now because there's not as many jobs to go to, right? Because the hiring wasn't as great. And according to a report I read by Spith, 52% of voluntary turnover, the employees said their manager or company could have done something to prevent the resignation. That a lot of the reason that they left was due to fairness issues and compensation issues. So to me, that's kind of frustrating that over half of those, we had control over the situation and could have done something about it if we wanted to, right? The fairness issue, I think, we hear a lot of that about territories unfairly being assigned, quotas not, mapped to the territory issues, those kinds of things. So, I think that's something to look at. And the problem with that is that, frontline managers, as you said, Jeff, are a real key to a lot of making this work. But the problem is, I also read a stat earlier this year that said 75% of first-time sales managers never received any training on being a manager. And it gets worse as once you've made manager, director, VP status, the likelihood of you getting training is pretty nil. On how to be a manager, not necessarily on product or anything else, of that nature is different, but on how to be a good manager, how to properly coach, how to have those one-on-ones, how to be in tune with a rep that you're at risk of losing. And what do you do about it? How do you go about changing that and making them not at risk of leaving? And so I think that's where this all, we have some big problems and falling apart, is because the frontline managers don't understand how important they are to their rep success and the tenure of that rep. They don't understand the difference between coaching and what a one-on-one is, or a forecast meeting. They're not in there helping as often as they could. So, I think that's a big area that we as companies really need to take a look at. If you're going to promote somebody and make them a manager, give them the training and the tools on what being a good manager looks like. Because the odds are they never actually probably had a good manager that they can try to emulate as well. And I love what you said, Jeff, about the promotions. If we are promoting within our own company, it's always great, but we need to do it smarter. For instance, we did a report, it was a couple of years ago, but SDRs were being promoted really way too quickly. And we found that if SDRs were promoted before they spent a year in the job, so they got promoted into being an SMB AE or a mid-market AE, that they had a 65% failure rate. So, that didn't do anybody any good at the company. So I don't know why we would want to do that. Yes, the SDRs want to be promoted and they want to be an AE, but you're not doing them a favor because you're not setting up for success by promoting them too quickly. You're not setting up that sales team for success because now they've got a rep that is not going to do well. So it just totally messes up the company in general. And I think that is a big issue and a big area. We also did see, ramp time is anywhere from 4 to 9 months to ramp a new rep. The average was at 5.3 months, which was up from 4.3 months the year prior. So, as Jeff said, there's a huge loss when ramp takes so long. And if you're in the enterprise space selling $100,000 average deal size or more, that could be a 9 to 10 month ramp time. So one thing I do want to put out there that we have seen in working with some other companies is that we knew we overhired, and the average percentage of reps making quota was down to like 50%. To me, that's a horrible place to be. You've got a lot of motivation issues. It's not good for the company to only have 50 to 55% of your reps making quota. So maybe having smaller numbers gives the reps that are left an opportunity to succeed. And if you do some additional things to help them be successful. So I think there's an opportunity there again to look at what do we need to do to make the reps left that we have to be more successful. And let's get that up to 80% of our reps meeting quota. You've got much better motivation, much better drive for your reps at that point in time, much more excitement around the whole area and your company that I think could only benefit the company.
Yeah, and if I can add there onto what you just said, Sally, there's the whole morale and the whole feeling of the sales team. Can you succeed? And when you see people around you not succeed and attrit, you wonder, should I be leaving too? You wonder what's wrong. You wonder, can I get to my quota as well? So, quota, attrition, overhiring, managing attrition, ramp, quality of manager, all of these things are intertwined when it comes to the feeling and the culture that reps have of success and of achievement. And once you start to lose control of that, you can really be in trouble, and your attrition could accelerate and leave you even in a worse spot that you have to dig out of in the future.
Well, I heard ramps mentioned a few times there. Sally, talk about the purpose of ramps and how companies can drive improvements there.
Yeah, so obviously the purpose of the ramps is that you can't hire a new person or even promote somebody from a different position and put them in and say, now you're a sales rep, you will make quota day one. It doesn't work that way, right? They have to build up the pipeline in the territory and learn the process and the company and everything before they start doing it. And if you've got, even a 3-month sales cycle, that ramp time has got to be, before somebody is up making quota, minimum of 4 months. But building that pipeline, I mean, one of the things I do like to stand by is that don't hire AEs unless you've got enough pipeline for a new AE, right? There's nothing better as a sales rep than to come into a territory where you've got a legit, and I will say legit pipeline that you can start immediately working and getting your hands dirty in. If they're taking over a pipeline from another rep, unfortunately, we find too many times that pipeline, there was nothing there, right? And so in reality, they're starting from scratch. and building it up. So, you know, different market segments require different ramp times, right? As I said, enterprise ramp times could be 9 to 12 months, whereas an SMB high velocity sale could be 2 to 3 months. So you need to look at that and what your average deal size are. Some of the areas where we've really seen you can make some impact in reducing that ramp time is by providing better onboarding experience. And the onboarding experience, we do a great job in tech companies on product. But we don't do a good job on talking about our buyers, what's important to our buyers, what are the different buyer roles, how does our product help them, what is the business value that we provide. It should be all around that business value, not about we're the best, we're the biggest, Gartner put us in their magic quadrant, but really solid impact and what is important to our buyers, and look at it from that. I think there needs to be a lot more, again, coaching from their managers, getting a top buddy system in place, right? Where you've got an AE who can coach and mentor them that they can sit in with and help learn from, that's done really well over the past year. Playbooks where you really outline your whole process and messaging, and the sales process in detail, so people understand what are they doing, can all lead to decreasing ramp times as well.
Now, Jeff, in my experience, ramps and plans often don't exactly represent what's really happening in the field, or they've been the same. I've seen from year to year. Can you shed some light, as someone who's built, what was it, 20 plans? Why does that happen? Why is that the case?
Yeah, I've been guilty of that. When I first started doing this, I was told by the CRO I was working for, who came from Oracle, that enterprise reps have a 6-month ramp. I don't know why. He didn't show me any data or analysis, but that's what we went with. And that's what I went with for a while, until I fully understood the importance of it when it comes to success. So I do think, and we've mentioned this a couple times, that companies need to understand their business. Start your planning early enough where you can go through and gather all these insights before you're even thinking about hiring and prioritization and segmentation and territories for next year, and truly understand not just the length of the ramp, but the shape of it. Maybe the length is right, but the shape is more of a hockey stick. Try to see what the differences and trends are between segments, between geographies, between managers, between cohorts that you onboard it, and the combinations of all of those things. And definitely come up with a plan. As Sally mentioned, a whole bunch of different plans and tactics that you can use to improve ramp. And even if, I don't want to say we don't want to improve ramp, but having consistent ramp is almost as important as improving it. If you set 6 months because that's what all the data tells you, but some are 5 and some are 8, and the next one's 4.5, the next one's 10. That's just as bad for your business as, having 6 or 7, and that needs to be handled as well, that consistency. So that's the first mistake, is people don't go in and truly understand why the ramps are what they are. The second is, it often comes down to financial decisions. If you make ramps longer because the data tells you they're longer, when you're planning for next year, you're going to need to hire reps earlier, and you possibly might need more reps, which makes that plan more expensive. So all of your ratios, all of your lifetime value to CAC, your percent of go-to-market spend to revenue, the money that you have available to put into marketing programs or other places, all of that comes into factor of making an overall plan, which is ultimately a company P&L work, come into play. So you tend to cheat on the ramps a little bit. Well, if we just reduce it a month, then we'll figure that out later, or 2 months and we'll figure that out later. It allows you to be more agile with your plan, in a sense of being able to get the better ratios to managers or invest in other things. And again, the opposite's true. As I said, if you shorten the ramps and all of a sudden you got more productive numbers that come out of it, and you like your plan, but you're not going to achieve it. So don't let a financial model consideration pull you out of being realistic of what your ramps are. Certainly put improvements in if you think that you need to drive them, but go back to what I stated earlier. If you're going to do that, have a formal program around actually driving those improvements so that you can achieve the outcomes that you want in plan. So have a plan, have a realistic view of what they are, look at the analysis, come up with what you think you need to do next year and execute a plan to achieve it. I think too many people just plug in numbers and move on and don't worry about anything beyond that, and really don't look at it until the next fiscal year when they come into planning. I think the other point that Sally made is, ramping up to what you think is full productivity of the sales rep also depends on pipeline. And I'm glad you raised that because it's just as important. I've had many like business war level conversations with my marketing peers. I have to hire 5 more people because that's what the plan says for next quarter. But, pipeline inbound has been flat for the last 2 quarters. Are you going to be able to increase it enough to handle the capacity that these 5 reps need? And if you don't, I think we have to have a broader conversation about not hiring these reps. Well, then we might have to adjust the number and we all need to reduce our spend. Well, maybe that's the conversation that we need to have, or at least have that conversation about how we can get that pipeline. They'll often point back the other way and say, well, if I can't step on the gas, do you have the capacity? And can you get the capacity in place to handle those leads? And I think that's a totally fair question. So I think incorporating the view on pipeline and what pipeline is needed against your hiring and ramp plan is absolutely critical to driving that success as well.
Well, another factor, right? Quotas. Let's talk about quotas. Because quotas are always a point of contention. Do you raise them? Do you lower them? What's the right quota? You want people to be productive, but at the same time, you want to keep the morale of the sales team up, especially, in eras or times like we've gone through last year. Jeff, how do you think about it? How do you think about the considerations for, having a higher quota and the financial accomplishments that come from hitting a higher quota versus maybe having a lower quota and sales team morale?
Yeah, it's I think, in addition to territory is one of the most challenging things that we need to do. I know that Sally and Bridge Group have a lot of benchmarks and statistics and things, and I've used them before as well, because one of the considerations has to be financial and productivity based. You can't have reps on a 300 OTE with a 600 quota. So you have to consider those, and you have to consider the ranges of those. So understanding the financial and productivity metrics do matter. I tend to argue that once you understand that and you get that in there, is for you to make a deliberate decision on what sort of distribution that you want, what you think is healthy for your company, what you think fits into the financial model, what you think drives the sort of morale and motivation that you want in order to achieve your goals. And what I mean by the distribution is, how many reps do you want to finish over quota? How many reps do you want to be between 80 and 100%? How many reps do you want to be over 50%? How many reps do you want to have below 50%? And if you set it in the correct way, those reps almost automatically should go on plan, after a certain amount of time. So I think before you actually set the quota, you need to understand which financial and productivity metrics you're going to use and look at to evaluate them, because they are important and you have to consider those. You are going to look at what sort of distribution you want against a whole bunch of different criteria. You're going to have to go look at, again, know your business. What have you done historically? And if you were to adjust or change quotas, back test those numbers. What would it look like historically? Would it make a difference? Would it get you into those sort of distributions that you want? And I also think you have to think about the other factors if you want to maintain or raise quotas, which isn't the worst thing. What factors impact that? So again, it's not just about the financial, how much does a rep cost us? It's about how much pipeline there is. We've already mentioned that, how much good pipeline, so people have a better chance of getting to their quota. It's the deal size, your win rates, your velocity. If you can work again, formal program to improve those, reps can deliver more out of the pipeline they already have and get closer to those quotas. You actually have a chance to start moving them up. The onboarding and enablement, both for the reps and as Sally brought up, for managers. Is your pricing model and packaging conducive to getting the sort of, things that you want, and, the payment for the value that you think you're delivering to your customers? So you have to look at all of those, because all of those also impact how you set quotas. I've been in meetings and rooms where a person has very much demanded, whether it's the CFO or the CEO, that you need to raise quotas by 20%. And the answer is, why do you think that's just not going to decrease, distribution by the same amount? Because we're not doing anything to actually enable the sales reps and the sales team to deliver more. And that's, again, I just think, a recipe for disaster, and it leads to increased attrition, all of the problems that we talked about with that before. So again, understand your business, understand which financial metrics you want to use. Don't just pick the one and allow people to pick the one that best, makes their case. Agree on those before you go in. Do the analysis, thoughtfully and deliberately agree on that distribution, identify programs to improve attainment, regardless of where you set the quotas. And then I think you'll have a better chance of setting them not only where you think they need to be for your business, but of actually achieving that target distribution.
Yeah, I mean, definitely challenges in setting quota. Sally, I know you and the team at Bridge has done a lot of research on this, talked with a lot of people. What do you tell people about best practices around quota setting?
Yeah, so there's always, a lot of different answers to this. I mean, I would definitely look at data, but when you look at data, I think you've got to look at the data also by, again, market segment and average deal size, because that really impacts it. If we look at the data that we have, the average quota was, I think it was 700,000. But when you look at companies that had deal sizes that were 25K or under, it was like, closer to 600,000. And then if you look at the data broken down by companies that had average deal sizes of 100,000 or more, the quotas were up to 1.3. So there's a huge variance there that you have to take into consideration, like Jeff said, as to the average deal size, your market segmentation, the velocity of a deal. And this is where I always use my numbers to figure out, okay, what would that mean in the amount of pipeline based on our close rate to close, a quota of 1.3 versus should it be 800,000 or 900,000? Is that realistic? What's the opportunity and the chances of success for driving that? And there is a wide variance. Like Exactly came out and said that only 58% of reps were making quota. Forrester says it's down to 47% of reps are making quota. Our report, which was from 2 years ago, showed 68% of reps making quota. So it is kind of all over the place, but that tells you that we haven't done a very good job at setting quotas properly. And as you get larger, the task becomes even more challenging, because then that issue of fairness, are you setting the territories properly based on quota? Or should you have a one-size-fits-all quota for every kind of role that you have, right? Or do you base it on the territory? Because let's face it, very rarely are territories all created equal. And that there's not a one-size-fits-all model. Are you using the data that is out there? We have so much data available to us now that we could really do a much better job of creating territories that are equal, but I don't think that we're doing that. We could look at how many leads are coming in per territory, how many outbound leads are being generated per territory, how many companies that is our ideal company profile that is in each territory, how many customers are in each territory. And so you could start by, again, using data that we have available to us today to help make those territories more equal in size and to help you understand if there's a chance of that territory meeting quota rather than just saying, I mean, it used to be, I know when I was in sales, and sorry for people in the Midwest, I'm a Midwest gal, but the Midwest was always like one of the worst territories to sell into. But yet they had the same quota as the people on the East Coast or the West Coast. And so it kind of doesn't make a whole lot of sense. And that's again where you get a lot of people that are like, this isn't fair. I'm leaving, I'm going somewhere else, kind of thing. So, and I know the VCs have a formula that they use that it should be anywhere from 3 to 5 times. Your quota should be 3 to 5 times your OTE. For smaller deal size, it's more 3 times, 3 to 4 times your OTE. For larger deal sizes, it's more like 5 to 6 times OTE. That may help as a general rule of thumb when you're an early stage startup. But again, I think as you get larger, you need to get a lot more sophisticated about assigning quotas and really understanding, what will work and not work there.
Yeah, it all turns into this vicious cycle, right? If you don't set quotas right or territories, morale goes down, you start to trip people, you do things to try to prevent that. You're not improving your ramps, you got a bunch of new people, you're maybe putting in bonuses to get the reps that are left closer to their OTE without actually delivering more so that you stem attrition. It's so important that you get these things right because they just can collapse upon each other and make the overall situation of magnitude worse than just missing one thing. They all are related.
Well, we have about 5 minutes left. I know we have a few more questions I wanted to get through, but if there's anything in Q&A, please pop it up that we haven't already answered. Please feel free to shoot it to me in chat or put it in the Q&A section, and we will make sure we get that answered. With that, maybe we can go real quick as we're seeing if we get any more questions coming in to once planning's over, what happens? The new fiscal year starts, it's time to execute. It's inevitable that you have gaps, right? As you start to execute on the plan, gaps open up. And it might not just be downside. I don't mean to just suggest that the downside, there could be upside opportunity. Sally, when you think about the beginning of the year, respect to the plan, what signals do you see that might think or indicate to you that maybe it's time to adjust the plan or replan even?
Yeah, so I think one of the great things about leading today is the amount of data and information that we have available to us that was a lot harder to get at even 10 years ago, let alone 20 years ago. And so using AI can really help give you those early signals into where things are falling apart on your plan. And I always do look at, if I don't have the pipeline being built that I know I'm going to need to have to deliver the plan, that's my really early signals signs. I use it not only to decide when to hire AEs, but also when things are going awry. If I can't build pipeline to the tune that I need for my sales reps to close, things are pretty much going to fall apart. Right. And so that's what I always keep my eye on the pipeline building side, whether it's from the SDRs, AEs, channel partner pipeline, marketing pipeline, whatever, wherever, in all cases where it's coming from. And so that's where I would be looking at to see what do we need to do to get that back up. And because again, that's going to make or break, I think, the plan along the way. And, I think that there is a fine balance between moving too soon and making course corrections and not giving the plan enough time to work out. But again, I think using some of these smaller early signals, you can certainly make, tweaks and refinements without blowing up the plan totally to help ensure that you are moving along on the right path. And getting that feedback from the reps is really critical. So staying in tune with the front lines and the people that are out there doing the work is critical to making those determinations.
Thank you. Well, we just have 2 minutes left. I thought maybe I'll let you wrap up, Jeff, and give us your 3 takeaways, from the conversation today.
Yeah, thank you, Eric. I think the first one is take your time to be very thoughtful and deliberate in planning. It's whether you're talking about the strategies or identifying the levers, understanding your goals and how you're going to get there, making sure you understand your business and all of the assumptions that need to go into planning. Number 2 is have a real program and a real plan to drive those improvements or to drive that change that you need in order to get to your plan. And the third is, I think, what Sally just said, always measure and always forecast and always look towards the future. And in order to do that, you need to identify and agree on what KPIs you're going to manage. You can't look at 100 of them, identify which ones you're going to use for your business, measure them, always measure them, and always talk about them, and always identify both opportunities, as you said, Eric, but those risks, and have a formal process for identifying how you want to handle those. Don't, just because your plan was made and frozen doesn't mean you can't make those adjustments. So when you have enough information today to say you should make some of those adjustments and course corrections, go ahead and do them. Things change over all that time.
Well, thank you, Jeff from Revcast and Sally from the Bridge Group. Appreciate the chat today, and we hope the audience enjoyed the conversation. With that, we're going to end the session. Thank you all.
Thanks.
Thank
everyone.
you.